the last lesson for pre-fi in business finance, and that's the determination, identifying sources and uses of short-term and long-term funds. Budgeting or budgetary control has already been discussed last time. So in the assumption that funds are already on hand, or that in the assumption that the company or the organization is in search of funds, the company has yet to define first what kind of funds they are looking for. Because from that, they will have to look for particular sources. The nature of the funds also determines the nature of sources for these funds. If you need short-term funds or short-term finance, then you will look for sources that deliver or give out funds on a short-term basis. If the funds are long-term funds, then your sources should also be able to cater to long-term monetary funds. So to start, financing in a business can be of two types: short-term finance or long-term finance. Short-term finance has something to do with decisions related to your current assets and current liabilities. Remember, what's so distinct about current assets and the current liabilities is that they are recognized within a year ends date. So within that year, before the end of the year, or in a span of 1 year, that's the duration of consumption of an asset or the settlement of a liability. Anything that goes beyond 1 year will have to be probably identified as non-current. Anyway, we have already defined them. We have already identified what these account titles are in Fundamentals of ABM 1. But at least the term is not unfamiliar to us, since current assets and current liabilities have already been tackled previously. When you talk of this short-term finance for current assets and current liabilities, we're of course also referring to working capital finance. It's a working capital as it is really used for the purchase of current assets, which are not to go beyond 1 year. It's also considered working capital because it's what's used to settle liabilities that are also within a year's span. If it should go beyond a year, that short-term finance should be limited up to 3 years only, or that it has a term of up to 3 years. What are the sources, the main sources of short-term finance? First is a cash credit. A cash credit is one that is credited to a bank, or that a cash credit is one that requires the involvement of a bank, where the company has to make arrangements with a bank on how much cash they could get for the purpose of a year's operation, and at the same time, interest will be charged. The bank will have to charge interest. The credit of that interest will be given to the bank, that bank who granted the cash credit. Assuming that Nicole is running a store, and if the store has just started its operations for that year, Nicole realized that there is quite a shortage of funds to finish the year. In her decision not to shut down the store, she made arrangements with a local bank or with a city bank to comply with whatever requirements she should comply with in order to be able to obtain a cash credit. Of course, the bank will have to charge some interest to the credit that Nicole has been applying for, and then once the credit is approved, once the cash credit has been approved, there comes the funds that Nicole can now utilize for the year or remaining amount of time for that particular year, so that her business will not have to necessarily shut down. You can also have financial loans, short-term loans from financial institutions, from lending institutions. You can have bill discounting, which is a short-term source of finance and it requires a particular leverage of how much will be charged the moment someone applies for a loan. So Nicole, oh no, let's use Nathan this time. Nathan will be discounted. Nathan will receive a particular discount in terms of what he's going to supposedly pay from the overall loan that he'll get. So that's quite a privilege that Nathan could enjoy in his wish to get a short-term fund, in his wish to have a source of a short-term fund. A letter of credit is also available. A letter of credit is an indirect form of working capital, capital financing, and banks assume only the risk, with the credit being provided by the supplier himself. So the only risk, there are quite two entities involved in a letter of credit. The first one is the creditor, and the second one is the supplier. The second one is the bank. The bank is the only one that shall assume the risk behind the letter of credit. Risk, a possible risk there is that what if that request of a short-term fund won't be settled. It's the bank that will have to suffer. That's the only risk that they'll have to suffer from. The bigger risk lies on the one applying for that loan, or the supplier himself, because there just might not be any amount granted by that institution to the supplier. For instance, no, Nicole owns the bank. Nicole is the manager of the bank, and Nathan is trying to make that short-term loan. Nicole will then be ready to assume the risk that perhaps interests of that loan will not be settled. But if Nicole decides that this is going to be very questionable and disadvantageous to her end, the bigger risk will have to be suffered by Nathan. And what is that risk? The loan will not be approved. For Nicole's fear of not being settled, not just with the interest, but with the principal amount of the loan. That's a letter of credit. Another short-term source or short-term finance source would be intercorporate deposits. It's a deposit made by one company with another company, normally for a period of 6 months. So there is an involvement now of one company to invest for another company. So you have company A involving company B. Company A is in a shortage of funds. So company A will make arrangements with company B, hoping that company B would grant some deposits to help company A. You have commercial papers as another form of short-term finance source. These are used in the form of a promissory note, carrying the undertaking to repay the amount on or after a particular date. So it's more or less just like a contract or an agreement that there is this amount being borrowed. That's how simply it's going to be constructed. There's an amount that's being borrowed, and then these are the terms for the payment of the amount, and that there's a promise on when that amount will really be settled. That's a commercial paper. Factoring. You can also go with financial institutions that offer services relating to management or financing of debts. Should there be issues when it comes to monetary management, financial management, there are institutions, financial institutions, that could cater to these concerns. The ones that you have there, SBI Factors and Commercial Services Limited and Can Bank Factors Limited, are actually international banks. These banks exist, and they are really identified as factors or factoring institutions, financial institutions, to cater to concerns regarding management and financing of debts. So these banks will then provide you options. These banks will then provide you opportunities to help opportunities to help you settle obligations regarding current liabilities. But of course, a company should be ready that by being involved with any of these financial institutions, there is some form of, it's not termed like a collateral, but there's something in exchange that they should offer or give or promise to such a to such a factor or financial institution. You also have working capital advance by commercial banks. This now involves commercial banks to provide working capital advancements. So these are earlier loans previously set, like when a firm wants to invest in long-term asset, when there is a longer period of time and that there's a need for more funds, the company could have perhaps foreseen already that there is a need for future funds or funds of this amount for the future. So commercial banks will have to be involved, and that an advancement of working capital has been made previously. That is to be ready for whatever it is that will have to be spent for in the future. This is where the company should try to have some form of foresight of where they are quite directed, so that if they wish to have an expansion, like if after a year's operation or 2 years operation, if the business wishes to have an expansion and that looking at the funds they cannot do it yet, they'll make arrangements with the commercial bank to grant them the advance of a working capital, so that by the following year the expansion can really be pushed through. Not that when the following year comes, the expansion cannot happen because as it turned out, still the short-term funds of the company weren't enough. In the presence of short-term finance, there will always also, of course, be a chance by which financing will have to support long-term goals or long-term objectives. To that, we have long-term finance, which could be internal or external. Internal long-term finances include share capital. So these are the equity shares and preference shares, the shares of stock that shareholders possess or contributed in the formation of the company. Like if there are 3 of us, our own shares of stocks will constitute the capital that we will have to use for the long-term operations of the company that we are establishing or we are leading. Acting as the corporate owners or the corporate owners, it is from our shares by which we could drive the company to whatever long-term goal it's supposed to accomplish. So equity shares could be one internal source of long-term finance. You also have reserves and surplus. The moment the company has decided to, or not just decided, when the company has identified its goals and directions in its formation, automatically or obviously, that company should be ready to have some from the total revenue at a particular year. The company should learn to have some reserves, which will be spent for whatever future use that reserve will have to be spent for. The revenue, which if it were in a corporate structure, the revenue will not have to be stated as dividends completely. While dividends can be shared or distributed among corporate owners, a portion will remain to be untouched, so that if the business wishes to do other plans, to do future plans, the reserves or the surplus will be the only ones to be used. The original value allotted for dividends will not have to be touched anymore. As dividends are going to be distributed to shareholders, we will leave dividends at that. Now that we have this reserve fund, for future operations, for long-term use, we will use that particular share. One more internal source would be personal loans and advances from owners. When owners personally choose to make a loan, because the loan will be placed under the name of the owner, and that the owner will have that forwarded in the name for the purpose of the operations of the company, long-term operations of the company. So these are three internal sources of long-term funds. What about external sources of long-term funds? You can have term loans from banks. These are your loans that carry with them interests, not just in a year. As suggested, this is for long-term funds. So this is for long-term loans. Loans that run for 5 years, not just 3, but 5 years, 7 years, 10 years, with particular terms in the settlement of the loan. You also have debentures, loans and advances from friends and relatives, intercorporate deposits, Asian depository receipts or global depository receipts, and commercial papers. So you also have those things identified as the sale of an asset. While you can make a loan, it is also possible that a company may just decide to be liquid with its properties, with its assets. Liquidity has something to do with how quick the company's assets can be converted to cash. So that means a sale of an asset. Like for instance, a property, a particular parcel of lot. Assuming that the company is in need of so much funds for long-term goals, and then it turned out that there's a particular parcel which has not anymore come out to be quite beneficial, perhaps even requiring more cost of maintenance to the company. One practical decision that the company could do is to sell that particular land, parcel of land. If not sell it, put it on a lease. A clear example to this is the Alta building. You should know, I think Nicole knows this already, because Nicole, were you already here, Nicole, when that building was not yet a mall? When Alta was not yet a mall?
Hindi ko po, wala pa ata ako dito.
Were you aware, are you aware, Nicole, that the building where Alta is constructed now was once a university?
No, sir.
Okay, let's use that as an example. Nathan knows this for sure. The building where Alta Mall is constructed now was once a university. That the university's name is Holy Name University. The earthquake happened in 2013. 2013. The earthquake happened in 2013, and then that building turned out to be not functional anymore. It was a public nuisance already. They tried to retrofit the building, but there were just so many damages inside that it would be impractical to have it repaired. So what the university community did, what the SVD community did, was to put the lot on a bidding. And the one who won the bidding for the lot is Alta is owned by Alturas, Ma'am no? Ma'am Ka? Ma'am Elsie. Alta is owned by Alturas. Alturas. So Alturas won the bidding for the lot of HNU, for the HNU main campus. They have not really sold out the lot. They're putting the lot on a lease. So it's for lease right now. Up until now, the lot is on a lease. So what the university did, what the SVD community did, was to look at what practically could be done. Lease it, at the same time, lease it and then gain from it. At the same time, a mall will have to be constructed on that lot, as how the winning bidder had decided it to be. Now there's just one campus. And the profit that the university had gained from the lease of the lot is now being used as an additional fund in the operations of the other campus. That's a sample sale of an asset. Equipment can be sold, or furniture can be sold for as long as it is deemed necessary so as to finance long-term goals of the company. Ordinary shares and preference shares. As we were talking about share equity earlier, share capital earlier, this also reminds us that shares can be preference shares or ordinary shares. Ordinary shares are the usual equity shares that we are referring to, which gives the owner the right in the profits of the company or to be able to have his or her own share of a dividend. At the same time, that ordinary share grants the owner the opportunity to vote on meetings. So when you talk about shares that are being divided on whose share is higher than someone else's share, so we are referring to ordinary shares or equity shares. We could also have preference shares. These are these are entitling owners to a fixed dividend even when ordinary shares are not. So preference shares are on top of ordinary shares. One's involvement in a corporate organization entitles him right away to a corporate share or to an ordinary share or an equity share. On top of that is a preference share. Beyond having an ordinary share is a preference share. It's not even used. It's not a preference share cannot even grant someone a writing or a voting right in a corporate organization, because it's the ordinary share that would really give such an opportunity to a stockholder. Again, the preference share is on top of the ordinary share. So can your membership in a corporate organization be fine if you just have an ordinary share? Yes. Yes. Debentures. These are loans that are usually secured and are said to have either fixed or floating charges with them. So when you talk about a secure loan, a loan which does not have so much risk, then you have a debenture. A secured debenture is tied to the financing of a particular asset, such as a building or a machine. So when a loan is being made, that item parallel to the loan is serving as the collateral for that loan. That's why it's secure. Like for instance, the company wishes to have a loan of 100,000 from a particular commercial bank for the purpose of expanding a business. And then what will the commercial, because the bank wishes that it be really secured, the bank and the company agreed to have a secured debenture. So the company will have to present something to the bank, and by the bank's approval, they will accept it as something that will be tied together with the loan. More probably, a particular land title. What if there's just a small land that they intend supposedly for one purpose, but they have not used it yet? So that's the land title the title for that land is what they're putting as a collateral. So the loan becomes secure in such a manner that if that loan is not paid in due time or is not settled, there is something that the bank holds against the company for its failure to comply with the payment of the loan. So again, the risk has been reduced, the risk has been minimized. That even if there are problems in the payment of the loan, the bank again still has something being held on its hands, securing itself, the bank securing itself from the failure of the company to settle the loan. Overdraft facilities, you can also have a hire purchase, lines of credit from creditors or having credit lines. You can use that for long-term finances. Grants, grants are most of the time offered by banks. Mostly banks offer grants. Not so many lending institutions may offer them, but banks can offer grants. Ah, yes. Banks offer grants. Grants are special incentives, special privileges, especially for the purpose of, especially if someone has been patronizing that particular bank, meaning so many of its transactions have been with that bank, or it has been very judicious in the payment of its loans, and that the bank found the company to be quite well responsive in its payments, and so the bank will grant the company a particular grant. Venture capital. It's a vital aspect of the source of finance market over the last 10 to 15 years. It is the capital contributed at an early age in the development of a new enterprise, which may have a significant chance of failure, but also have a chance of providing above average return, especially where the provider of the capital expects to have some influence or the direction of the enterprise. So in the outset of an enterprise, or yeah, at the outset of the enterprise, in its early stages of development, capital has already been continually provided. There's a continuous provision of capital such that as what possibility might have been stated, there is a possibility where the company might fail and the capital invested might turn into a very big loss. However, if it doesn't turn out to be a failure, if the company turns out to be successful, the person or the owner or the owners contributing, continually providing the capital, will have gained so much influence because much of the investment has come from them or has come from that owner. Example, the three of us have agreed to have a store, a small scale business. The three of us have agreed to have a store. Then Nathan decided, okay, next month I'll try to put this amount. Next month, and then comes January, Nathan then continued to say, I'll try to add in something more. Comes February, I'll try to add in something more. And the business, we have noticed, the three of us, that the business has been going so well. Now that Nathan, among the three of us, is the only one who's been contributing continually a form of capital to the business, much of the influence comes from Nathan. Not much from Nicole and myself, because all that we did was to probably assist in the operations of the business. After having done our first share of a capital, we didn't anymore do much or additional investments. Nathan did that though. So in the long run of the business, Nathan will have gained, he will have gained a bigger influence over the life and direction of the business. The last one is an invoice discounting. This enables you to retain the control and confidentiality of your own sales ledger's operations. There are times when we have to make debts. At the same time, there are other companies who would owe us something. Remember, in accounting, we term that as a receivable. When other companies or when other entities owe us something, that's a receivable. When we owe something to another entity or to other companies, we term that a payable. So debts, they exist. This invoice discounting ensures that customers do not know you are using invoice as the client company sends out invoices and statements as usual. It makes a proportion of the invoice available once it receives a copy of the invoice sent. Once the client receives payment, it must deposit the funds in a bank controlled by the invoice discounter. The invoice discounter will then pay the remainder of the invoice less the charges. So there is now an involvement of partial, no, the word partial is inappropriate. Um, the amount that they owe us will be discounted because maybe there is something that is unsettled between us and them. I'll use the both of your names. This is how invoice discounting could work. Nathan is running one business and so is Nicole. In the run of Nathan's business, he could not help it but ask for Nicole's help for his long-term funds. So now Nathan owes Nicole some money. Nicole purchased items from Nathan's store through a receivable, through an invoice. When purchases are made through an invoice, no cash is involved. Take note of that. So when Nicole received the items, she didn't pay any cash. Technically, Nicole owes Nathan some form of amount. Diba? But will Nicole pay that value in its full amount? Not necessarily. Because Nicole's invoice will now be discounted as Nathan also has some amount that he owes Nicole for his request of additional long-term funds. Because Nicole granted Nathan some financial help, Nathan will acknowledge that and provide some discount to the amount that Nicole is supposedly going to pay him. Thus, the invoice is discounted. But it's not necessarily that it does not mean that Nathan should not be paid by Nicole. That the amount Nicole owes Nathan should be brought to zero. No. If that's the case, then Nathan will not be earning anything at all. Nathan has to acknowledge some revenue, but at this point now, the total revenue is discounted because of that instant when Nathan requested for monetary help, for long-term monetary help coming from Nicole. That's invoice discounting. Questions? What's just commonly practiced when we talk about sources of short-term and long-term finances? Generally, you'll encounter the term loan. That's more or less the general term. It's just a matter of how the loan is being translated into. It could be translated into a loan where you have to promise a payment at a particular point in time. It could be a loan involving another party, not a bank, but the presence of another company. Nicole, if you don't mind me asking, Nicole, when your parents structured that store, was there a loan involved?
I don't know, sir.
You haven't gone into asking that point, not from your knowledge
No,
or
sir.
anything.
Hindi ko po alam.
Don't ask them anymore
Basta
how you
alam ko.
don't use my subject. Sir Sim wants to know if there was a loan that our family made so that the business will be operated. Don't ask them, Nicole. Take a Nicole.
Yes, sir. Yes, sir.
Don't.
Yes, sir.
Don't ask her the things you're gonna say. I think one time in our business finance class, I asked you, are debts helpful in a business or are debts harmful in a business? I think this was posted in our Edmodo page. The question was placed there. Try to recall your answers. Debts are not all that bad. They're not all the while harmful because debts can sustain short-term and long-term goals of an enterprise, of a company. While it's possible for you to really maximize cash or all of your current assets for that purpose, but the moment these current assets run out, you'll have to probably resort to making a debt, filing for a loan. But the challenge there is, or that the bigger challenge there is, once you have qualified for a loan or applied for a loan for the company that you're running, you should be committed to the settlement of that loan. That is why we've mentioned this earlier. There are really banks who will do their best to secure the loans that have been filed to them. They will ask for some form of security, collaterals. They're creating debentures. Because also these banks would not want to be disadvantaged. They're open to the possibility, of course, that what if the business that has made the loan won't really flourish? The bank just cannot wait until that perfect time that the company really flourishes. No. So the bank must secure itself as well. Questions? If there's none,